economics, and enjoyed it as much as I did because Martin Wheel was one of my main teachers. I had another, the very first lecture I had was from someone called Frank Hahn, who was a great theorist. And he gave me a book to read, most of which I couldn't understand, but I do remember the very beginning of it, which was this: that the most serious challenge of the existence of money poses to the theorist is that the best developed model of the economy cannot find room for it, which, as a beginner in the subject, I found slightly alarming. And then one read on, and of course, for Hahn, the best developed model of the economy was, the highly stylized theoretical Arrow-de-Breuil model, which right from the outset sort of rules out money because there are all these multiple barter markets which work absolutely perfectly. So there's no need in Arrow-de-Breuil really for a medium of exchange. There's certainly no distinctive characteristic to something called money as opposed to any other asset. And actually that basic idea that you need some frictions both to justify and explain the behavior of money and how it interacts with the economy is still there in many of the core models we use. So in most macro models, I imagine in NIESRs, any sort of structural model, the core demand relationship, the sort of IS curve, if you like, will be based on some optimizing behavior of the consumer. You roll forward the optimizing condition, put in a budget constraint, and you'll come up with something like this: that consumption is a linear function of wealth. I've represented it here with W as net financial assets with some average price P, say, and then human wealth as the present value of all your labor earnings, and then some function of interest rates. And the point about this and about the demand relationship in, as I say, in just about any macro model is there's no special role for money here. All there is total net financial wealth and human wealth. And that is, to say, the basis really for, I won't say models are exactly like ISLM, but they are in this particular respect, in that there is the same dichotomy in the model that Hicks wrote down almost a century ago, which is that monetary policy works. So in ISLM, a sudden increase in the stock of money will certainly do something to inflation. In the end, it'll have a one-for-one impact, but it only does so via interest rates and asset prices. So in the ISLM setup, demand is determined by interest rates, subject to other exogenous movements. And it's only by reducing interest rates, by pushing that LM curve out, that you affect demand and inflation. There is no direct role for money in this setup. And you might think that maybe there should be, because surely a lot of that W is money. But as you will know, let me skip forward a couple of slides. Even though a lot of gross assets are money, so that the light blue bar, the bit above the line, these are UK figures in trillions of pounds. They're pretty much fully offset by the debt that households and the private sector more generally owe the banks. So money is not net wealth, or at least the interactions of the non-financial sector with the banks are kind of neutral. And similarly, by the way, QE, the same applies to QE. So I've long disliked the phrase printing money for various reasons. One, because central bank money is not, as the textbook often has it, a zero interest asset, at least for the last, whatever it is, 18 years. We've paid interest on that, so it's not the money of the textbook. And second, printing money somehow gives the impression of a Friedman-style helicopter drop, that we're just doling out cash, and that is not true, obviously. The central bank provides new reserves, but it takes something away from the private sector in the process. It takes some gills. So as far as the private sector is concerned, QE just is an asset swap. It gives up one interest-bearing claim on the public sector and gets another in return. So obviously, this subject to a change in prices, there's no effect of that transaction on this W term, and therefore it remains the case in most of these models that the only way you boost demand is via change in asset prices and interest rates. And how does that happen? Again, I'm teaching grandmothers to suck eggs here, but I'm going to use this because I think it's not an unreasonable way of representing QE. Central bank in an open market operation buys gilts, provides more reserves, and that pushes down yields. And it pushes down yields here because there's imperfect substitutability between money and bonds, so that money demand line has a slope. Another way to think about it, which is more intuitive, is just when we buy the gilts, we push the price up, which is the same as a decline in yields. So that is the setup. And as I say, it's not identical to the models we used, but this dichotomy, by which I mean an expansion in the money supply, only affects demand via what it does to asset prices, including short-term interest rates. That is certainly a feature of many macro models today. Now, there's some big oversimplifications with that LM curve. As anyone, and there are several people here who've been on the MPC at least, will know, it's not really a great description of how we set the policy rate. It's not an unreasonable description of QE, but you don't actually have to supply more reserves to reduce bank rate. And indeed, if you read some economists like Woodford, you don't even need central bank money at all to be able to vary the interest rate. But I'm talking mainly about QE today, so I think it's a stick by this description. Another problem, which I'll come back to, potential problem, or at least wrinkle on this, is that when you read your textbooks as an undergraduate, the fact that this MD line sloped down was justified by the assumption that reserves at the central bank do not pay interest, but they do. And so I said a moment ago that that slope exists because there's some imperfect substitutability between reserve deposits at the central bank and gilts. So even though they're both, as I say, interest-bearing claims on the public sector, you need some difference for this to work in the way it does. In other words, to have that slope, and I'll come back to that point because I'll try and persuade you that actually that slope can vary, and the fact that we pay interest on reserves means that the slope is flatter than it otherwise would be. And finally, certainly when I read these textbooks, now ancient, that I read as an undergraduate, there was just some mechanical link assumed between now what was called narrow money, which is these reserve deposits that banks have at the central bank, and broad money, which is the money that matters for the economy. That's money for us. That's money in commercial bank accounts. And the one was meant to just move entirely in proportion with the other. And as we'll see, that's definitely not the case. But in the 60s and 70s, and all the great debates about inflation at that time, the more monetarist economists, so-called, had a deeper complaint about this setup. And in particular about this sort of dichotomy, as I put it, that if you expand the supply of money, you can only affect demand and inflation by a change in asset prices. And their view was certainly of something like a helicopter drop. So imagine, suddenly we've all got an extra 100 quid in our bank accounts. That it wouldn't simply be the case that we go out and, buy government debt or buy more financial assets with it. We would surely spend some of it on goods and services directly. And that was the link for them that was missing. So at least if you retain the language of ISLM, this was an argument that money should appear in the IS curve somehow, not just in the LM curve. And at times there was disagreement even amongst people who might, from the outside, have been viewed as monetarists. I mean, Friedman often argued along ISLM lines, I have to say. And I don't think any of them would have denied that this relationship I just showed you. But for many, like Brunner and Meltzer and so on, they would have argued that at least in addition, you had this kind of dotted channel up at the top. And I have to say, I have some sympathy with that view, at least when it comes to additions. If you imagine, again, this helicopter drop of so-called broad money. Now, it's true that in some ways, and Wellen has written a lot about this and will challenge me, I'm wrong about it, under some conditions, if you literally just put £100 in everybody's bank account, that would add to this W term. I mean, it depends on the relationship between the Treasury and the central bank and whether the Treasury has to recapitalize the central bank. So a helicopter drop would work by those means, even in ISLM. But imagine a situation where the central bank or somebody does that, it puts £100 into everybody's bank account, but it actually finances that with a tax on other assets, say. And I think plausibly, very plausibly, that would increase overall demand, even with no change in interest rates. So one could justify that sort of dotted line, because in the real world, some people are more credit constrained than others. And this is precisely the kind of friction that would really matter and make money matter. And certainly the MPC often argues, just through the conventional interest rate channel, that, you know, when we put up interest rates, those, you know, debtors are more liquidity constrained, and they're likely to cut back on their spending by more than depositors, even if deposit income goes up as much as interest payments do. And that because of these differences across the population, even a sort of wholly, fully tax-financed helicopter drop would have demand effects, because those receiving the money would on average respond to it more forcefully than those who are having to pay for it. So I think that's very plausible, although it does work, as I said, to my mind, mainly for broad money, and one still needs to tell a story about why, if we do QE, that's going to amount to something like a helicopter drop, which, as I say, in my textbooks was something that just seemed to be assumed. So for these reasons, I think it would be wrong, always wrong, for any monetary policymaker, even one using a model, you know, that looks roughly like an IS curve, to ignore the monetary aggregates. And certainly the MPC doesn't. Equally, however, it cannot be true either that these are the only things you would need to look at. And certainly, they always require quite a lot of interpretation. And I want to just remind you now of some of the big features of how they've behaved over the last 30, 40 years, just to see. And certainly the simple accounts, some of them I've read, of the current inflation, that somehow QE always causes exactly the equivalent change in deposits of commercial banks, this broad money notion, and that somehow, you know, M4 is uniquely determined by the size of the central bank's balance sheet, and then that any change in broad money must be followed by inflation. Those things are clearly not true in the data. So this is back since the beginning of inflation targeting, and they're both relative to GDP, these measures. The one is quotes narrow money, just reserves at the central bank, that's the blue line, and then the orange line is broad money. And there are a couple of things that are pretty clear here. One is that long before there was QE, there was extremely strong growth of M4 over the first 15 years of inflation targeting, close to 8% a year. Second, obviously, reserves get pushed up enormously by successive waves of QE. Actually, the first jump was when that change was made to start paying interest on these deposits. That was back in late 2005, I think early 2006. So before then, when they were zero interest assets, banks economized them. So, I mean, literally just a few million of them. And then interest on reserve remuneration started, I think, in late 05. You see a little jump there. And then these successive waves of QE. This is up until the pandemic. You see these huge increases. But over that period, actually, broad money growth slowed considerably and grew no faster than nominal GDP. So in terms of the money that matters, which is the money in our bank accounts, the bank accounts of companies, this broad money notion, its rate of creation, so-called, was far lower and has been far lower during QE than it was before. So that's one set of facts one must wrestle with. And another is that despite these big swings in both measures of money, inflation across both those periods, so this is the decade or so after the first slug of QE up until the pandemic, and then the first 15 years of inflation targeting, average inflation was pretty much bang on 2% in both those periods. So certainly the crudest interpretation that anything that we do via QE to increase the quantity of reserves must result in exactly the same proportionate increase in broad money, and second, that every change in broad money results in inflation, those things are clearly not true. Yeah.
So just maybe to refresh my memory, what was the argument for interest on reserves as early as 2005?
It was in order to control the overnight rate better. Again, Willem will put me wrong if I'm wrong about this, but what was found was that because banks were minimizing so much on them, and the money market, the interbank market, in which the overnight rate was set, became highly volatile, the interim objective of the operating regime is to make sure that that overnight rate equals bank rate, and a lot of the time that wasn't true.
We did just want to get more liquidity into that market. So
they wanted to get more liquidity so that they could control the overnight rate and keep it very close to bank rate, and then basically to achieve that end. But as I say, I think it has some other consequences, including for the way QE is transmitted. So these are two facts which I think are worth dwelling on and worth trying to explain. And I think one can through a perfectly monetarist framework, say something about them. Let me just check I'm not, yeah. I mean, one thing to say is that about the determination of this broad money thing is that commercial banks are perfectly able to create new money and indeed destroy it without any matching change in deposits at the central bank. If the bank lends you £100, as you get a loan from the bank, what it actually does is put £100 in your deposit account. That is new money. It's new broad money matched on the asset side of its balance sheet by a loan, money that you now owe the bank. And that is the way in the modern economy that money is created, the money that matters, as I say, commercial bank deposits. And none of it need involve a role for reserves. And I think, and I'll show you a graph later on that demonstrates quite how long this went on, because I think if you take this back 10 years, you'll have seen it have gone on for a very long time, basically a quarter of a century, with huge growth in credit and credit ratios. And in the process of extending loans, commercial banks created new money. Now, when we do QE, we do actually, pound for pound, not proportionately, we do create new broad money. As long as you buy the gilt from a non-bank, you will create a new deposit. But the overriding thing going on in that decade after QE first began was that the economy was growing more slowly. I'll show you some other facts that help to explain this, but certainly lending was growing more slowly, and that was the dominant influence on broad money. So there was no mechanical one-for-one link between these two things. The other big issue, recognized for centuries, literally, is that the demand for money, whether central bank money or broad money, can move around. And this is kind of important to recognize. So turning back to this, which, as I say, I tend to view as, can be helpful, not necessarily for broad money, although something similar applies, but certainly for QE, you can see shifts not just in that MS line, as it were, but that MD line. And indeed, let's see what I've got coming. Quite often, I think, and I'll show you some episodes in a moment, there are certainly periods when QE was more about meeting an increase in the demand for central bank money than it was outright trying to ease monetary conditions. It was really often about preventing a market-induced tightening in monetary conditions. So to the extent this occurs, and to the extent you think at all that policy is transmitted via interest rates, obviously this would weaken the link between central bank reserves and nominal GDP, for example. There's another thing that goes on, I think, another complication here that also disrupts that relationship, which is that certainly for central bank money, the slope of this line can change. I mentioned earlier that I think it's got to be true that paying interest on reserves will tend to flatten that money demand line. It increases the similarity, if you like, between the two sides of the QE transaction. So an absolutely perfect market, and I always think something of an irony given the strength of feeling about QE, that in the perfect, fluid, Modigliani-Miller world, that orange line would be completely flat and QE would do nothing at all, whether good or bad. I don't think that's true. I think it does have some slope, but I think it's clear that the slope can vary, and there are periods when markets are acutely illiquid, and suddenly central bank money has a very distinctive liquidity value, different from gilts, and that line has a pretty steep slope. There are other times when markets are more liquid, and even though gilts are long maturity assets, I can repo them and get cash, and the two sides of the QE transaction look more similar, and that line is flatter. And that too will complicate the relationship between narrow money growth and spending in the economy. If you look at the episodes where asset purchases have had the biggest effects on gilt yields, it is when, I think, by other measures, things like bid-ask spreads, markets are pretty illiquid. So there's some of that definitely right at the start in 2009, again in the dash for cash in 2020, and perhaps most obviously, even though this wasn't an MPC intervention, last October. The bank pre-announced it, but on that Tuesday after the mini budget, the bank bought £1 billion of bonds and yields were down 100%, 100 basis points from where they had been a couple of days earlier. That's pretty powerful. Whereas there are other times when similar quantity of purchases does much less. The fact that the demand for money can change definitely also applies to broad money. And I think is, why fundamentally the 80s eventually saw these money targets, intermediate targets for broad money growth put in by the incoming government in '79 were abandoned. They kept being missed and inflation fell anyway. So broad money growth stayed very, very strong. Inflation declined anyway. I described earlier how that money might have been created in the act of extending credit. And it was as if both the demand and supply of broad money were increasing at the same time, because around this period, not only did financial liberalization meant that there was a lot more credit growth, it also meant there was a lot more competition for funding and for deposits. Banks started paying interest on deposits. This is here, the orange line is the gap between the average interest rate on bank deposits and the 10-year gilt yield. And you can see that for a long period of time, the bank deposits became more attractive as a store of wealth relative to securities. And I think that helps to explain why you had such strong growth of broad money without any implications of spending or inflation. This was money, in other words, as, quotes, a store of value, not as a medium of exchange. So you have to take account of these things in interpreting these movements. And I don't think the sort of crudest story really holds water next to the evidence. I want to talk a little bit now about the inflation we've had now, this extraordinarily high inflation. And it is absolutely true that was the big surge in broad money, reflecting mainly accumulation of deposits by households, during the pandemic. And actually, I think that the MPC at the time approached this and thought about this in arguably a sort of monetarist way. So remember that IS curve, this pushed up W for households. So in whatever form that wealth was held, whether as money or as anything else, you might expect this would give an additional boost to consumption once we came out of lockdowns. But we certainly thought about whether that boost would be bigger because of the liquid form of these assets. So, if you go back all the way to this relationship I showed you earlier, I mean, this is a rough guess. If you run a very simple version of this, that F thing might turn out to be about 5% a year, something like that. Households spend about 5% of total wealth a year. We actually, in the forecast we made, I think had a number closer to 10% for these extra deposits because they were liquid. So it's precisely a kind of Brunner-Meltzer calculation, if you like. And not only that, but this did look quite like a helicopter drop. Certainly, it looked like excessive deposits, and that's what they're now popularly called. They're called excess deposits. For my part, it's not clear to me that, frankly, that they were, quotes, caused by QE in the simple sense that every bout of QE results in this. We've just seen that that's not the case. I think the proximate cause was actually a combination of huge restrictions on spending plus fiscal support in the shape of the furlough scheme. So income was still coming in, but people couldn't spend, and they just accumulated all these extra deposits. Yeah.
When the bank saw these excess deposits, did you start worrying about inflation?
Well, this is what I'm talking about. I mean, this is the kind we thought about it in those terms. We thought, well, will this give a really big boost to consumption once we come out of lockdown? So if you look at our forecast or read the inflation report, it's not now called the inflation report, the monetary policy report. I think, say in May 21, as we were coming out, we thought, yeah, we had a additional little boost from this. We talked about how it had arisen, what would be the implications for demand and inflation. However, I think it's hard to say that this is a big part of the inflation that's followed. So for one thing, and we did do that, we added to our strong forecasts. The data were much weaker. Consumption growth, aggregate demand growth were weaker than we predicted over that first year. These are the forecasts from the May inflation report. And spending turned out to be a lot weaker, not a lot stronger than we were forecasting. So it's hard for me to tell a story about these extra deposits being a really big cause of the inflation, given this. Not only that, if you run a simple consumption function, so take that one I showed you earlier with just wealth, and then add separately money, household money. So allow it to distinguish between monetary and non-monetary assets, and you get something like this line. So we were above that line, and it turned out, the real world turned out to be weaker than both. Now, I have to say, this line, but not this line, includes the subsequent changes in income. So all the big real income squeeze that started coming through towards the end of this period is not in here. So that explains some of this gap. It doesn't explain this gap because this one has the actual realized income in it. And I think, there may be other things going on. It may be, I mentioned how important the distribution of net wealth is, and some people being credit constrained and others not. As it turns out, a lot of this extra money belonged to people who were better off and older, and therefore less inclined to spend it. So that may help to explain why we actually overestimated, not underestimated, the effect. The other thing, of course, and Jag alluded to this, is a purely money-driven inflation would basically lead to equiproportional rises in all prices. But that's not remotely what's happened. This is just across the CPI, the variation cross-sectionally in annual inflation rates, absolutely enormous, and we know where that's come from. We know it was non-energy goods in 2021. That was a global phenomenon. Our interpretation is, and we had this interpretation again early in 21, although we vastly underestimated how far it would go. the pandemic boosted the demand for goods. People shifted away from services to goods globally. And at the same time, it impaired the supply of goods, much of which came from Asia. So you saw this huge rise, and we know, it was in things like computer chips and cars and white goods and so forth. And then, of course, as I say, this was a global phenomenon across all countries, including those who didn't do the same amount of QE. And then, of course, last year, tragically, the war in Ukraine and what that's done to energy prices, particularly in Europe. So you can see how much worse it's been for us and indeed for continental Europe than for the United States. And I think it's hard for purely a money-driven model to explain the scale of these relative price shocks. What seems more plausible is that the pandemic and then the war caused these things, and that because of the resulting and huge squeeze on real incomes, we've then had second-round effects, very big ones, on growth of domestic wages and prices. And that seems to me a more plausible story. Now, none of that means that it is, it's always true, of course, that I can look back in time and imagine a path of monetary policy that would have kept inflation on target. But that's not the same thing as saying that QE caused the inflation. Now, the problem here are these long and variable lags, and things can happen in the interim, and they certainly have. Suppose the MPC, I'm going to come down to the bottom line in a moment. Suppose the MPC had the foresight to see both the scale of the pandemic effects and the war and the resulting second round effects on domestic wage growth and inflation. And you ask yourself, what path of policy would have held inflation at 2% over the last 2 years? I haven't got the interest rates on here. This is just the inflation rate. I can tell you the path interest rates would have to have got to close to 20% to achieve that. And, to produce the scenario line. And that, by the way, would have produced, a path for unemployment in these are simulations on the Banks model, something like that, and a path for nominal wage growth at the bottom there. So one of the points I made in a speech last autumn is this is a real shock, pandemic and the war. The consequences for real income are unavoidable. It is not the case in that sense that inflation has caused weak real income growth. Unfortunately, the weak real income growth is caused by a curtailment of supply of non-energy goods, then energy, then food. And unfortunately, that's an unavoidable hit to our real national income. And you can see that nominal wages in this scenario, keeping inflation at 2, would have fallen by 5 or 6%. And actually, aggregate real income growth would have been worse thanks to this rise in unemployment. One could do one more wrinkle here, which I've done, which is to say, suppose we followed this path for monetary policy with interest rates going up almost to 20%, and we had enough to offset the shocks we've actually seen to import prices. Let's instead suppose that we have the same path for interest rates, but we don't subsequently get the shocks. So in other words, we said in 2021, right, we think there's a pandemic's going to have these nasty effects, and we think there's a war coming in a year, and we think it's going to push up energy prices. Let's push up interest rates to 18, and then we'd not got these other things, and Russia had not invaded Ukraine. Then what you get, is this path for inflation. So this alternate thing says, follow the type policy that would have been enough to offset the nasty shocks we've had, and then suppose we don't get the nasty shocks, this is what happens to inflation. And for me, this is one thing that persuades me. I think that the idea that the preceding jump in broad money is the main story about the inflation we've had, I find hard to square with the data, I have to say. Now, I have got something about QT, but I'm overrun. So why don't we start taking questions? And if someone wants to ask me about it, they can. So we can read it in the speech.
Seems very simple. I think we can, maybe someone can ask a question about QT, but we'll let Ben take a minute.
No, I'm kind of done. So
yeah. So why don't you? Thank you very much. Ben, would you like to sit down? We can take some questions.
Sure, yeah.
Very much. It's that's exceptionally clear. We've talked before about, and I think you made the same point without using the same language, that being an inflation nutter in response to a supply shock is not an optimal policy. I say that's my words rather than yours.
Yeah, I mean, I think that there is absolutely no doubt that had we seen these things coming, policy would have been tighter earlier.
Yeah.
I mean, nor is this the optimal outcome. You're trading off slack against inflation. You would have made a different trade-off had you seen all this coming. We wouldn't have, I doubt, gone that far and been the inflation nutter and had unemployment go up to whatever, 12, 13, 14%. Equally, we wouldn't have had inflation of 10 and probably unemployment would be higher than it is now. I think that's fair. So we're not at the optimal now either.
One question did occur to me while looking at your analysis, which I nearly completely agree with. It was just that we looked at the projection of consumption demand in about May 21. So our expectation using bank analysis, judgment and models was for a relatively strong consumption rebound. It then took until December for rates to go into reverse. And I wonder whether you're able to say anything about the delay at that point.
Yeah,
if delay is the right word.
Well, I mean, obviously, we didn't think we were. Equally, I think the strength of the case was growing. One of the big difficulties we had at the time was you say it was recovering strongly. It was still, we have just now, remember, the economy has just now got back to where it was in December 19. And so there's a sort of overarching point that you would not expect zero growth over a period of more than 3 years to trigger this kind of rate of inflation. But what was true as well is we reportedly had millions of people still furloughed. And I mean, looking back, I have doubts about the quality of those data, obviously, because there were still meant to be 1 million even days before it ended. And that was certainly very tricky for us because we had projections which sort of naturally implied that, not literally, some of those were jobs, not people, I think, but that there would be a material rise in the available workforce once that furlough scheme ended. And that did not materialize. And looking back, rates went up the moment it didn't, but we were pretty uncertain. And, you can see the doubt beginning to increase, but certainly in the spring and summer, we took those numbers completely at face value.
Yeah.
And as I say, actually, demand was always, obviously, it was coming back strongly, but not as strongly. I mean, I mentioned the furlough scheme because I agree with you. There were other things at the time. I think I gave a talk in early 21 about this demand switching and what it was doing to inflation. We could see there were some odd things going on in the labour market, even in early 21. People were being hired from the ranks of the unemployed before furloughed workers. So I don't know, why is that happening? So there was no doubt, with the benefit of hindsight, there are things that you think, but I have to say it was only once we realized that those, the end of the furlough scheme had not done anything like we expected some months earlier that we were able to heighten rates. I mean, I have to say, go through all these simulations, if we'd started 3, 4, 5, 6 months earlier, I don't know, maybe a maximum half a point less inflation now.
Yes. Okay. Well, I've got an excellent audience. Let me maybe collect up 3, take them back to Ben. When you ask a question, may I just ask you to keep it brief, because lots of people want to ask questions, and let us know who you are. I know who you are, but everyone else may not know who you are. So we'll go 1, 2, 3, and then we'll collect those up.
So Reece Bidder, King's College London. I wondered if you've done any analysis on decomposing where that expected use of excess deposits went in some sense. If it didn't go into consumption, was it wealthier households moving towards less liquid assets, like the wealthy households suggest they might? Or I just wondered where it went.
Okay, I'll take that one, and then 2 others. Yeah.
Thank you.
Thanks, Nick Mannion, Alpha Line Asset Management. Thank you for the speech and the event. So You mentioned briefly your speech in the autumn, and I think in that speech, you also suggest that market pricing at the time, which I think was for a 5.25% bank rate, was likely beyond.
No, it was over 6 at the time.
Yeah, it went up to 6 straight after,
Yeah.
if not higher. Yeah.
Was likely beyond what would be kind of.
Yeah.
So again,
Okay, I'll come back. Okay. Okay.
I just wondered if that was that assessment was still valid, or whether the kind of facts have changed.
Okay.
Yeah. Thanks, Nick. Thank you very much, Neil. Just pass it to.
Martin Wheel, also from King's College. In July 1973, the bank rate went up 2 percentage points at the start of the month and another 2 percentage points at the end of the month. Now, has the MPC discussed larger increases than actually happened? Obviously, it has to go up a half, and you might have discussed a quarter. But let me rephrase my question. Has the MPC discussed increases of 1% or more as a single move?
Thank you, Martin. That's the quota of King's College questions. Anyone else from King's can't ask any more.
Okay,
Ben,
very quickly,
in any
but
rule.
on both those. I mean, not so seriously that they appear in the minutes as a serious proposition, and no one is. I mean, any MPC member is free to vote for any level of interest rates that he or she thinks fit. And I think maybe a couple of times when people were musing about it, but I don't think, as you know, no one's voted for it, and there wasn't a sort of separate paragraph in the minutes that said we would. I don't think that's out of any particular opposition to the idea. I don't think we sort of ruled them out. It's just that in the event, people thought, no one's voted for more than a half-point rise. On the question of the level, look, I'm very, very. I think it's probably, as Jack said, I've been in this job far too long.
I didn't say
that.
I didn't say that.
I've never said, here's what I think interest rates will or should be. I used to have to do that in my previous job, but now, blessedly, I just vote for the current interest rate. The circumstances last summer even were pretty exceptional. And that was a very, very much the exception, not the norm, that we, both I and that talk and in the minutes, said something about market interest rates. It's in general not something we do. We're about to embark on another policy round, and you'll find out soon enough what the latest interest rate is going to be. But I think there were exceptional circumstances, actually. And then on the question of the deposits, I mean, those were drawn relative to nominal income, which kind of helps. Yeah, so nominal income has, grown pretty strongly. The other thing I'd say I should just mention here is that, so some will have gone to spending, but others are just sitting there, falling relative to nominal pay. You can also interpret what's there in slightly different ways. So some people who pay a great deal of attention to monetary aggregates will say, look, they're falling, and there's our negative growth in wider M4, and this will presage much weaker growth of nominal demand and inflation. There's another view, which is a kind of buffer stock view, which is that of the determination of money demand, that households, firms are tolerant of relatively small increases, and they only do something to adjust their money holdings once it hits certain thresholds, in which case the level is more relevant, and there are still a higher level of excess deposits. So interpreting that where we are is not entirely straightforward, even if you pay a great deal of attention to them. There are different views about what it implies.
You get some of your students to estimate some broad money demand equations, can't you? Yeah, I can see it. So
Yeah, they have. I mean, we don't. Yeah, I mean, some of it will have gone in consumption, but maybe less than we anticipated.
That's excellent. Another round of questions. So of Jerry, Catherine, Wilhelm, and we'll come to you second time round.
So I'm Jerry Holton. I was wondering what assumptions the bank made when it produced inflation forecasts, because there was something slightly strange about telling people at the end of next year, i23, inflation will be 2-3%, but we're going to go on raising interest rates. So we're sorry it's where it is, so we're going to raise interest rates even though we think it's unnecessary.
Well, remember that the forecast is conditioned on a yield curve which had more increases in it. Now, you're right, and I won't spend great, but it's, this is, I could drone on for hours about this question. I think, the medium person we have a lot of risk, upside risk in the forecast. The model is one, any model estimated certainly over the inflation targeting period, is one that will treat the effects and the second round effects of the falls we've seen in energy and other prices entirely symmetrically. And so if you put this into any sort of economic model, it seems to me, you've got these big increases in import prices, followed by second round effects. The model wants to say, yeah, they're all going to disappear just as quickly as they emerged. And I think it's fair to say that the median voter on the committee thinks that the risks relative to such a forecast are skewed to the upside. We worry more about the persistence of these effects. But it's also true that the forecast is conditioned on a yield curve which had further rises in it.
Why is the current inflation being supported by food prices? That doesn't sound like excess demand.
No, it's not. I mean, it's the effect of the war fundamentally, plus some bad, unfortunate confluence of very bad seasonal things, food production, and inflation and food inflation in Europe is pretty much the same. This is a traded good, at least within the continent of Europe, and a number of things. I mean, for example, Ukraine turns out was a big supplier of the chemicals for fertilizer. Food production, a lot of it is very energy intensive, so that's pushed up costs enormously. So a lot of it stems from the war, plus some other unfortunate supply events.
Just before we get to the next two questions, there's something that just emerged out of this strong mean reversion in models that was maybe under predicting the risks on the upside.
Yes.
Is that also reflected in expectations of inflation, the sense in which not necessarily you, but many central bankers say, I'm not worried because inflation expectations are well anchored. But if those inflation expectations are still driven by the same overwhelming power of mean reversion, they may well not be capturing the risks. Is that something you worry about in the UK?
The expectations that matter, which frankly are the sort of, in a way, a shorter term, we worry about all of them, but they do respond pretty closely to actual inflation. Sometimes people think they respond more to these kind of more commonly bought non-core things like food and energy. But there's no evidence until we get to over the inflation targeting period, say that they come down in response to falling inflation any more rapidly than any less rapidly than they go up. But it's the same difficulty anyway. We've never seen anything like this. There's nothing in the sample that is like this. I think that the feeling is nonetheless that the risks are that it will take longer to respond as headline inflation comes down. And we'll see. But I mean, you're right that models will always have that tendency.
Thank you.
Very nice. Peter, fixed income, no affiliation to King's College, so I'm going to ask two questions.
keep them brief, nice. Yeah. Keep them brief.
So the first one is you didn't talk about perhaps the extent to which there was uncertainty around the supply potential of the UK economy over this period, because it happened to sort of overlap with the UK decoupling from its largest trading partner. So I wondered whether maybe you could say a little bit about that. And the second question is, I'm very much of the view that, these shocks, the pandemic, the war, these are hits to our real income. It's not something that a central bank can somehow undo. I think it's a very worrying narrative to suggest that if somehow the balance sheet size had been different or bank rate would have been different, that could have, offset the impact of Russia's invasion of Ukraine or the pandemic. That's not going to happen. So that sort of links to the size of these shocks, these relative price shocks are really enormous.
Yeah.
And typically a textbook answer would suggest that the central bank should think about extending the horizon over which we bring inflation, a little bit for the reasons that you're,
Yeah.
counterfactual scenarios. So, but we're not hearing that from a lot of central banks. They're actually saying things like, we need to get inflation back to target quickly, and the quicker the better. So I just wondered if we learned anything from this experience about, the horizon over which we should get
Sure.
inflation.
Okay.
Thank you, Catherine.
Willem.
Willem. We'll take Willem. I think it's in the rule, but we have to give Willem the last word.
Willem Buiten. It's okay.
Yeah, you're good at pushing buttons.
Yes, I'll push your button.
Yeah, that's right.
We're a year and a half in this inflation surge now. And real interest rates in most jurisdictions, including the UK, real policy rates are still negative.
Depends at which horizon, actually.
Well, yes, but certainly over the horizon the next couple of years. My most expectations, but yes. One way out of that is to do what many in the US are doing, to have a sort of quantitative proxy of equivalent scale between quantitative tightening and rate hikes. So the effective Fed policy rate is supposed to be 6% plus now. Any similar statements for the UK?
No. Okay. Well, first, let me order them in reverse order. First of all, I'm not sure it's true that they're negative. I mean, if I think like consensus expectations for inflation in a couple of years, they're well below the nominal interest rate at that point. So I think real interest rates are high, and there's no particular. I mean, zero has no particular suddenly, credible step. We've had negative real rates for years and years and years without inflation. Now I understand, but it acts over the entire forecast period. And remember, for example, that even in this economy, there are now longer term. Most lending in the economy is not overnight, 2-3 years, and at that horizon, I think real interest rates are positive. As far as QT is concerned, I was going to come to, well, that's what matters. That's what matters. What is the expectation? Well, it's more than the overnight rate, certainly more than it used to be, these 2-3-year rates, because 75% of mortgages, for example, are 2-year rates. The QT I was going to come to, whenever that plot I showed you earlier of the different effects on the variable effects of asset purchases on bond yields was a surprise. It was relative to what we thought expectations were. And I think it's reasonable, certainly reasonable in relatively liquid markets, that what matters is the announcement. And that bond yields and forward interest rates embody expectations of this policy and what it will do. It would certainly be pretty weird if that were not the case. Maybe it's less the case in illiquid markets, but the MPC has already said it's not going to be selling assets into illiquid markets. And therefore, and I think this is quite an important point, it's the point I was going to come to, the way we approach this in the forecast is to say we are going to announce a program of asset sales, or at least a certain reduction in the APF, which we did last September, we would plan to do every September. That is then embodied in the asset prices on which we condition the forecast. So if you believe, which is what I've tried to argue, that this is a policy that works via its effects on asset prices, and if you condition the forecast on asset prices, to add anything else would be double counting the impact. And that's why we don't do it. So I don't think we need to. I think it'd be wrong to add some additional percent. It's already there in the bond deals on which we condition the forecast. So I don't agree with that approach. Catherine, you asked about productivity. Yeah, immensely uncertain when we were even before Brexit, as you say. It's added to the uncertainty about what the underlying, I once gave a talk about, it's the first talk I gave in this job. That is a reason why we're uncertain about productivity, I think, to start paying much more attention to the labour market than just to GDP growth. If you're sort of uncertain about whether it's, quote, demand or supply that's moving output around. It's one of the reasons we, even before this episode, that we paid a lot of attention to measures of slack and demand and numbers on wage growth, surveys of wage growth. And that premium on those data has grown all the more in this episode because of these second round effects. In terms of the horizon, I mean, again, the answer slightly depends on what we were talking about a moment ago, which is how persistent you think this thing is. I mean, there is, as we say in the jargon, which William and Martin will remember, a range of views on the MPC. And sometimes when it gets extremely said, there's a wide range of views. But there is a range of views. And for some people, I think their own personal forecast, they would, on this yield curve, have inflation coming back only 3 years as opposed to 2. For others, that's not the case. But you're right, in general, certainly with a big productivity shock, a not bad one, the remit tells us, it says directly, you might think about taking longer. And I think, when you hear that from central bankers, it is because of this concern about inflation expectations and the basic belief that the risks are skewed in that direction. And I've forgotten that. Wasn't there an earlier question? Did I have another one?
No, I think we've covered the questions of sort of being more explicit about flexible inflation targeting, how to deal with the uncertainty of supply. Just one perhaps dull question. You wouldn't expect anything else from me, but just on the minutes and quantitative tightening, I didn't notice a statement from the MPC about agreeing to a certain level of quantitative tightening or a particular stock of QE holdings over a horizon.
We said in September we would lower it by 80 billion.
Yeah.
And that's what we're doing. And, there was some potential complication, obviously, at the time of the intervention in October, but we've now got rid of that. Those gilts bought for FS purposes in October. So the APF is back on track and will shrink by that amount. And I think the plan is then this coming September to do exactly the same, saying here's what we're going to do. And remember that we said some time ago, and the outlines of this were thought about and announced a long time ago when Mark was still here, that we want this to be, quote, gradual and predictable. It is not the primary instrument of policy. The primary instrument is bank rate, which means that it's bank rate that's doing the legwork. And should we ever be in the other way around, and should policy have to be loosened, the first thing to do is to cut bank rate, not to change the path of the APF. So that is the plan. That's one of the reasons why we believe, because it's gradual and predictable, it's there in the price and it's there in the yield curve, and we don't have to have some additional effect for it. So I think we don't have to keep repeating that every month. And I presume that September is the next time we will announce something for the following 12 months.
Thank you. We're past the hour, so we can take. We take one. Can we, Neil? I'm in your hands. Can we take one round? I don't want to. What have we got waiting next door? Is it good? Hot food, cold food? Cake, and then it can wait. Let's take 3. So one here, and then one here, and then who's got their hand up the highest? We'll take you because you might be a student. And you might not be. But you're not at King's, are you?
I know, I am.
Oh, geez. Anyone else? No, you can. It's fine. No, I've got Canyon. So that's fine. Okay, it was your student, is it?
Yeah. All the more reason for
1, 2, and then 3. That's fine. You're let off.
I kind of want to jump Catherine's question. Well, basically, the last few minutes of your presentation were saying that if we were to pre-see what was going to happen with the pandemic, we would have put rates at 20%, or basically, if you were to look at it now, there's no there's an admission that the bank can't really do anything. And if as I understood it, because you talked about how you're looking at the extra consumption expenditure, and it's not like it doesn't match the extra deposit they had as a result of building up the pandemic. So and that's kind of what Catherine was saying, if I understood correctly, which was that it's unrealistic to say that the bank can control for these purely external events that are happening through inflation. So if that were the case, I mean, what would be-
Well, let me, because I'll answer that directly. Look,
Please do.
sometimes one hears, monetary policy can't do anything about, that monetary policy tends not to respond to high frequency changes in things like energy prices because it can't affect the supply of oil, which is obviously true. It is not the case that we can't affect inflation.
if inflation's from the price of oil.
No. Very important. We control medium-term inflation, okay? And we will get it down, and it will end up at target. There are all sorts of shocks, including domestic ones, nothing to do with energy. Hang on, just let me finish. That are not directly controllable by monetary policy. But, fundamentally, although sometimes I interpret it a slightly different way, when Friedman says inflation is always and everywhere a monetary phenomenon, I agree with him. They also said to relax. So there are lots of things between the setting of policy based on the expected outcome and the actual outcome. There are lots of things that can move inflation, but doesn't mean we're powerless. No. I said we are powerless to prevent the decline in real income, not nominal stuff. Real shocks, of course, we can't do anything about those. We can't do anything about we can't do anything to boost real productivity. We can't, not over long periods of time. What we can do over the medium term is get the nominal stuff right, and that is what we're going to do. What is true is that in order to bring down inflation, there will be a period, because this is the way policy works, in which the economy grows less strongly than it might otherwise have done. That is true, but we have no permanent effect on these real things, and there's nothing that could have been done to offset the consequences for real income of the war, of the pandemic. But the nominal things, absolutely, and that is what we will do.
Thank you very much. So, yeah.
Yeah, Bert Siegenthaler, Rockos Capital. Thanks very much. Apologies for asking a bit of a market-minded question, but just in terms of the last inflation report, which from a market point of view was quite a surprise and led to repricing of expectations. I'm just curious, in your own mind, how much of a negative surprise and disappointment was that, and what kind of implications it might have for you, and also maybe to rephrase Martin Will's question into the future, is there a possible scenario where you would say, well, actually 25 is not enough, as the Fed at some point seemed to think they need to go back to 50, or the ECB is still debating whether 25 or 50? Thank you.
Thank you, Bert. Should we just collect up the final question?
Yeah, and then
you can deal with it.
Yeah. So I was wondering, personally, I'm quite concerned about a wage price spiral and a detethered expectations. Just wondering, how concerned is the bank? And specifically, if we do see a very intense wage price spiral, how much are we going to have to raise interest rates? And can we still have a reasonably soft landing? And just on a side note, how likely am I to get employed after my degree? Will we be in a recession in a couple of years?
I'm sure you're very likely to get employed.
Absolutely.
Look, I mean, spiral is too strong a word. It's very, very clear. When I talk about second round effects, there's something like that has been going on for quite a while. If I have to think about what surprised me personally as an economist most looking at this, it is that. I wouldn't call it a spiral. You go back to, you go back only a couple of years. One way, and you think about the estimates that we had of what a real income hit like this would do to nominal growth, which is one way of phrasing this thing. Their real incomes get squeezed. To what extent do they try and retrieve that lost income, which is ultimately for the country as a whole irretrievable? But how much do they try in bidding up both wages and prices of domestic companies to restore their real incomes? Now, there were estimates by Steve Nicol and Richard Layard, which would have said something like you get 1% hit to real income, maybe that adds for a year or so a quarter of a point to these nominal things as people try and claw back. So it's not 1 for 1, but you get something. Now that estimate used to be a lot higher in the 70s and 80s. Maybe because labor markets were more rigid, maybe because the monetary regime was a bit all over the place. But that's where it had come down to. As Catherine said, there was an enormous hit. I mean, the hit to national income, say for the 4 or 5 quarters up until the third quarter of last year, was probably more than twice as big as the worst 2-year period of the oil shock in the 70s.
Mm.
I mean, like more than 5% knocked off national income, just enormous.
Mm.
But if you'd had an estimate of that region, a quarter or so, maybe 1.5, maybe 2 percentage points on wage inflation, above and beyond what's necessary to keep inflation at 2%. Actually, we've had more than twice that increase. And that is the central thing. I don't call it a spiral. And actually, in the most recent day of the last 3 months, notwithstanding the release we had last week, there are signs in the official data, but also in the surveys of some of that pressure beginning to come off, not nearly to the extent we need it to, but some of it just maybe beginning to turn. So it's there. And that is precisely the reason we've been putting up interest rates. And we say we're worried, but yeah, of course, that's why we've been tightening policy. And I'm sure we'll get a job. And then just quickly on we will do at any point in time what we think it necessary to do. As I said to Martin, we don't rule out any particular size or any particular change in advance. I'm about to go into a policy round. I've already started. In fact, that means hours and hours and hours of meetings and poring over data, and then we'll decide.
Thank you much, Ben. I really enjoyed so much the time you've given today and the thought you've put into your talk. In fact, I couldn't help reflecting. Last week, I gave evidence to the Treasury Committee. In fact, Catherine was there on the same panel, and we're regularly asked to try and explain the bank's actions as well as that of Treasury. And we've done that Lords as well a number of times. And I sort of cast my mind back listening to the discussion you just given on this question about whether inflation is caused by money or real shocks. And it reminds me of something I learned myself as an undergraduate about the Bullion Report of 1810, which was a very early example of a parliamentary inquiry into an inflation that had been caused by real shocks or nominal shocks. And there was an intense discussion of it, largely written by Henry Thornton, repeating many of the issues that are going around in circles just now. So some of these questions are timeless. As I said right at the beginning, we don't know the answers in real time. But what we're consistently trying to do is use frameworks and data and our judgment to try and arrive at something, if not the optimal policy, maybe is the least bad policy, is what we're trying to generally aim for. For those of you more broadly interested in these questions as well, I know there's some students in the audience. I was fortunate enough to be asked to give the annual public lecture for the Royal Economic Society last year, where I talked about many of the principles, but perhaps not the direct policy questions that Ben is talking about. And for those of you interested in those questions, do take a look at that public lecture based upon the book Money Minders. I'd be delighted to talk to any of the students about that at any time. Thank you, Ben, for making time for us this morning. Thank you for attending, but let me also thank my brilliant colleagues at NIESR, Neil Lakeland and his team, for putting this on what has been a glorious day.
Thank you very much.
And a glorious morning. Thank you very much, everyone.
Thank you.
That's great. Thank you very much. Yeah.
Sorry, so absolutely. It's very important. No, there's, as we said earlier, it's the one who put this to me very, very precisely. That is yeah, sorry, we've got the same thing. Did you leave it there? It was there, just this.